Hi, welcome back to the show. As promised, the Bank of India management is all ready to speak to my colleague Gopika Gopakumar. Remember, the asset quality has weakened a tad bit this time around. However, the top line and the bottom line have seen a good 20% growth. So there is Gopika in conversation with Vijay Lakshmi Iyer, the Chairman and Managing Director of Bank of India. So let's cut across to that. Gopika, over to you.
Mrs. Iyer for speaking to CNBC TV 18. To begin with, your NII growth this time is up 20%, so it's much better this quarter. What are the key factors that led to this growth this time?
Yeah, our NII growth has been quite good. At almost 20% growth is there. The key factor is that the entire bank, at all levels and layers, we focused on recoveries. So recoveries from all the bad doubtful and loss assets. Of course, we still have a long way to go. But then our recoveries and upgradation during the current quarter, during the first half of the current year, is almost more than what we did in the earlier last financial year. So this only actually has directly resulted in increasing the income part of it, and that has resulted in a growth of 20% on the NII side.
But despite the fact that recoveries is much better, asset quality continues to be a big concern. You're targeting a gross NP of 3% for the full year when the gross NPA this quarter has come in at around 3.5%. How hopeful are you that you will be able to achieve that target?
The current quarter NPA, of course, growth is there by about 26 basis points. Of those, we have technical NPAs to the tune of around 800 crores, which already would get upgraded in the next 15 days. So that is why I'm confident that that is one aspect. The second aspect is the recoveries of almost around 1,000 crores are visible for us in the current quarter also, put together, and also that there are no big accounts for us now in the current quarter sitting on the fence to become NPA. I'm quite confident that we should be able to contain. As I said, the target set by us is quite ambitious, quite optimistic. Our rollout efforts are there, and we want to bring it down to the level of 3%. That's why I also actually qualified that we may be around 3.15 to 3.20. Thus bringing down the NPAs in the current context when the economy has really not turned on is a challenge.
How is the existing restructuring book doing? Are you seeing any sort of slippages on that front?
In the current quarter, of course, the slippages have been slightly more in the restructuring book, almost around 1,200 to 1,300 is what if I remember my figures correctly, coming from about 40 accounts, 6 from CDR and the remaining from the non-CDR accounts. The restructuring pipeline is there to the tune of around 1,500 crores for us, and the current quarter also will be there, coming mostly from the EPC contractor side. This is one area, EPC segment, where we are seeing higher stresses. I hope and I'm sure that the government is taking steps on the power side, on the coal linkages side, so that we don't see fresh slippages, on that side. But should the pace of reforms lag behind what is required in the market, then maybe the restructuring, will be there more in the next quarter. We have, of course, made a request to both the government as well as the Reserve Bank that in that event, maybe there will be a need for them to look at the restructuring guidelines and continue further, maybe for a period of 6 months or a little longer.
So there is a concern in the market that because of the regulatory forbearance, as you spoke about, that will be removed by April next year. Will there be more slippages coming in from the restructured accounts? Because clearly after April, accounts will not be eligible for being restructured.
Yeah, clearly after April, we cannot do the restructuring as per the current guidelines. But the government doesn't, the RBI doesn't as such prohibit us financing even in case of an NPA accounts or a little before now. So we are at the job of identifying the accounts from SMA 1 and 2, which may require the restructuring based on the techno-viability study. So that is why I said maybe 1,500 crores may be there in the current quarter for the third quarter. And on the fourth quarter, let us see how the pace of economy picks up and turns around.
Loan growth this time has come in up around 18%. So good growth coming in. Where is the growth coming in? Do you see what is the kind of loan growth that you're expecting for the full year?
This growth of 18% is YOY. If you see the current half year, our growth is just 7%. On the domestic side, our growth is negative by 2%. We have grown only because of our overseas centers in the business, and mostly in SCNRB loan, buyer's credit, as well as, of course, some part of the oil companies taking the loan from us, and a few multinational companies who have gone abroad as part of that expansion. Otherwise, the growth on the corporate side is very muted, and we have only seen some working capital green shoots coming up, and those are the early signs of recovery. So I hope that will get continued. That's why I said for the next 2 quarters we really cannot expect for any high pickup in the credit growth.
But much of your concentration now is on the retail credit, and how is that pickup going to happen, considering that all banks are now looking at retail growth to drive their loan book?
Retail is one area where actually the demand has not slackened, and we have a demographic dividend in terms of the population who really wants to go for much of home loan, consumption loan. So that part of the bracket actually is there, pickup is there, demand is there. In fact, we have grown during the current half year by almost 77% in our home loan segment, and we hope that that will get continued. And therefore, we are opening more retail centers across the country, and we are focusing largely on the auto side and on the home side. Besides, we are focusing largely on the vendor and channel financing, and the dealer financing. We have got quite a few MOUs entered into, and we are putting all our efforts through our SME centers and our retail banking centers and also mid-corporate processing centers to increase, so that the quality is also taken care of, because the suppliers who supply to the multinationals will have definitely their credit history is established. So we are concentrating on that.
So what is your full year target for loan growth?
Our full year target for loan growth is around 15 to 16%. We really don't want to grow at the pace that we grew last year. So we are quite conscious of especially the risk-weighted assets. The loan book which actually attracts more risk weights like 150% we are avoiding altogether, unless and until we are confident of the rating and also the return. So we are very conscious, and that is why when I said that although the loan growth is 7%, our risk-weighted assets have just grown by less than 1%. That's why we could optimize on the capital front and improve the capital adequacy ratio too.
And how is your exposure to all the coal-based projects doing? Are you seeing any sort of stress on that front?
As of now, we don't see the stress building, because the government has allowed them to mine the coal up to March. But then eventually, of course, the government is working out very seriously, and they will come out with some solutions. So we will wait and watch what reforms they do and how fast they do, and then accordingly we will plan out our activities in that.
But what is your exposure to these projects?
See, we don't have any direct exposures to the coal block allocations accounts, but then indirectly, of course, these will affect the power units, this will affect the steel sector and also the cement sector, and we do have exposure to all these sectors largely. Our own exposure to the infrastructure segment is around 16%, and to the power alone is around 11%. Of course, of the power, 50% are to the SEBs where the state government guarantee is there. So then, otherwise, we don't see any concern as of now. But then going forward, we'll have to wait and watch.
Okay. And finally, your outlook on interest rates, are you looking at cutting lending rates going forward?
As of now, we have reduced the rate of interest on the deposit side, of course. Quite a few tenors, in fact. We don't have any plan immediately to cut the base rate. We did cut the base rate from 10.25 to 10.20 during the month of March 2014. We will wait and watch. We do see some of the banks cutting the base rate to 10.15 by private sector banks and also State Bank of India. If that comes in the way of our business, we will certainly look at it.
Thank you so much for speaking to CNBC TV 18.
Okay, that's the word coming in from Bank of India.